real numbers. It's a lot to go through. These are as realistic as possible because we operate some of them. So like these numbers are pretty close. But depends on your management style, etc. But we've laid out the big bulk items here and assumption here. So you can take it for your own we can take it for your own cross-check later on. So let's start with Toronto, right? The scope of work is you buy a legal duplex and you build a garden suite in the backyard. With the market now, if you really, try, like for example, we are trying to buy something in this price range for our clients right now and for ourselves right now. So you can buy roughly duplex between like 1 to 1.5, but 1.5 wouldn't make any sense too. So we're sticking with the 1 million mark, right? For a duplex, right? And in Toronto, you can easily rent for 3-bed for 3,000, 2-bed for 2,200. And if you build a garden suite in the back for 2-bed, you can easily achieve 2,300. So your annual rental is actually 90,000, much higher than 70,000 I mentioned, because this is Toronto. In Barrie, 70,000. In Toronto, easily 90,000. All right, that's somebody's salary a year. Your estimated operating expense, property tax, insurance, utility, etc. You have to pay for utilities in the common areas. So like, you still have to incur some utilities. And annual expense is about 15,500, excluding financing. All right. So let's look at the number on the right hand side. If you have room at an A lender, so that's your CIBC, TD, National, blah, blah, let's assume they can lend to you for 65% LTV and above. So your down pay is somewhere between 35% and below, all right? And interest rate is 5.5% fixed 5 years right now. I mean, these numbers, they're probably gonna drop, all right? But we're being conservative and using a higher number right now. And with a 25-year amortization, your mortgage payment per month is roughly 4,500, and you need to pay for land transfer tax. You need to have some reserve funds, and you need to have down pay. The reason you see here the reserve funds is so high, it's typically a few months of expense, but the reserve fund is so high is actually, Shirley, why don't you tell them why this reserve fund is so high? Because it's actually not a reserve fund. What is it?
Yeah, it consists of a renovation, which is a construction cost of building a garden suite in the backyard,
Right.
plus holding expense.
Okay. Holding expense is very negligible in this case. This is actually not a reserve fund. This is actually a construction cost. So maybe we should just label it better in the future. But I just want to point out that you don't need a large reserve fund. You need this much money roughly for construction. Okay. And a plus down pay. So short fund you need is roughly 720, and monthly cash flow is about 250. After you complete your construction, what you go to the bank and take the money out. You can roughly pull out your construction fund, which is about over 300. Okay. Now the assumption we made here is that after you build a garden suite, the entire asset has gone up from 1 million to 1.4, which is very realistic. And then with 70% LTV, the bank will give you back over 300K. All right. So really, how much money you're tied in the asset is about 400K. 41. Yeah, 410, like 400K, right? And then if you hold it for 5 years, we just use the 5.5 as assumption for growth, just because that's the historical data. You're looking at exiting about 1.9, and your mortgage balance by then would be 870. So your profit is roughly over 500,000, and your ROI is roughly like 25% plus. All right. Okay. I see a question. So is that garden suite unit with a basement or slab? It depends on the municipality laws. So for example, in certain areas, they do not allow basement. In certain areas, they allow more than 2 levels. So it depends. Yeah. Okay, let's look at the, again, it's Toronto. Same scenario, but you cannot qualify for an A bank. You qualify for B lender, which is your home trust, Equitable Bank, etc. Okay, same LTV, but their rate is roughly higher. So it's at 6.5%. And their amortization is also a bit higher at 30 years. So we run the numbers for you with this roughly the same construction cost and everything. See, your short term is roughly, again, you need about over 700K. Your monthly cash flow is down at $100 or so. Your equity takeout is roughly the same, over 300K, and your capital tied into this asset is roughly the same, about 400K. Okay, and because the rate is higher over 5 years, if you hold it with the same assumption, your mortgage balance by the end of the 5 years would be over 900. Like you see, it's about 50,000 more than the mortgage balance you would have if you qualify for A bank. And so remember the first option, your profit is about like 500,000, and here your profit is about 465. So not too much of a difference. There is a difference. So the ROI is down a few points. It's like 22, 23 points. Any question at this point? Okay, let's move on. So that's Toronto. Okay, now this is what I'm talking about. Nowadays, just because I went through the construction process, I would not recommend a newbie to do it. It's always more budget and more time and more cost than you think. For somebody new who has a tight budget, you really probably cannot not afford going through the process. So what I actually recommend is you go buy either a legal duplex with an existing garden suite in the backyard or like a triplex, right? Those numbers would be different a little bit, but like in general, it looks like this. So purchase price roughly, let's compare apples to apples. So purchase price 1.4. You can have a rent roll of, again, 3-bed for 3,000, 2-bed for 2,200, and 2-bed for 2,300. Your annual income, again, is 90,000, and your operating expense roughly 1,500. All right. Now with this, your bank can probably lend you higher at 70% LTV, and we use the same rate. Right? Okay, so the magic is because you do not have to do construction. Literally, the bank will lend you that part of the money up front because it's already built. So the short-term fund needed, meaning how much money it is to tie up in this asset, it's about 500,000. So remember the last option we had, you have in front about 700K, then you take some money out. In this option, you don't take money out. You just put in roughly 500,000, you get this thing done, and you don't have to go through construction. In this market, just because we went through construction, like the cost just went skyrocketing, I would not recommend any newbies out there to do it. Like you better buy with existing garden suite or triplex, right? Now, you see the value exit roughly at 1.8%, and the mortgage balance, we have that laid out, and your profit is gonna be around 350,000. And a B lender, if you go with B lender, your rate will be higher and your profit will be roughly around 300,000. So you see, like it's lower than the first option where you already build, and the ROI is lower. If you went with a lender, it's 13 to 14%. If it's a B lender, it's 11 to 12%. It's still good, and it's safer, and it's much less work. So if you're a big risk taker and if you don't mind going through like all the surprises and all the shit show in construction, sorry, excuse my French, and like you want to get the max ROI, go to the first option, which is you build, right? Which is this one. But if you're more conservative, you're just starting out, want to give it a try, see how it how does it feel, right? You go for this option, which is, you know, you buy an existing one. Okay, so that's Toronto. Any questions at this point? Okay.
I saw someone raise the hand. Just 1 second.
Okay.
Hi, Dave.
Hello.
Hi, Dave. I just tried to unmute you.
Hello?
Hello? Yeah, we can hear you now.
So what I don't get is like I understand why you're building like while you're investing in duplex and triplex in like Hamilton, Durham, and everything like that. But the market's slightly changed right now in Toronto.
That's right.
In High Park, for instance, you can get like a 6-bedroom house that's
Mhm.
already been done for about like 1.6 to 2
Right.
million,
Right.
right? And
Yeah.
so you're making about probably about like 150K.
Mm-hmm.
And it's basically what's happened is like if they're you know, private companies, they're getting out because they don't want it, they don't want the property anymore. Or another thing, and they've already been done. They've already been like, you know, made into apartments, units. So you don't have to have that construction stuff.
Yeah. Yeah.
So I mean, and we're only talking about 200,000 maybe.
Mm-hmm.
And there are numerous properties in Parkdale, numerous Parkdale. And yeah, it's just
Yeah.
bigger reward, not much more in terms of you know, the purchase price.
Mm-hmm.
Like Toronto is changing.
Yeah. 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 So you want to hear me out on this?
Sure.
Okay. So we do a lot of multifamily. Duplex, triplex are for beginners. We do a lot of multifamily. The ones that you are talking about,
They're called they're condos. I mean, not condos, I mean they're buildings.
yeah, they're multifamily buildings. Now,
Yeah.
do you know they're purpose built or no?
Are they, what do you mean purpose built? Yeah, they've already been segmented into the various units.
Okay. So if they're being segmented into various units, those are not purpose built. Those are what we call retrofit. So people like us, we don't like to touch retrofit buildings because we did that before and the plumbing and everything was a nightmare, which is a retrofit, and the risk profile is much higher with those buildings. So we okay, so there's a lot of people and different groups buy multifamily buildings in Ontario,
Yeah.
and we typically like to stick with purpose built. So that's number one. Because we did segmenting into those, we did conversion before, and just
We don't have to do conversion with these. Like they're already, you know, done.
Right. So
You're
those
gonna have, it's Parkdale's an old neighborhood, so you are gonna have things like plumbing issues, electrical issues, and things like that. But that's just, and you're gonna have the same problems with the places you're doing. So it doesn't change because these are the older houses too in Barrie and in Hamilton.
right. So how do I? So in the future, like later this year, we're gonna do multifamily series as well. So like
Yeah.
we can dive into all the details, but essentially, multifamily buildings, there are two types. One is purpose built and one is not purpose built. We don't touch, and a lot of people don't touch retrofit, which is not purpose built. So somebody took existing, single family house or whatever, and they section off into apartment buildings, which it's in its whole category, it's its own category that we don't touch. It's because of there's other risk associated with it. Number two is that those buildings run on cap rates. They're not run on ROI so much. They're more run on cap rates. So we actually watch Toronto pretty closely too, because we buy in Toronto too. Part of our portfolio is Toronto, and a lot of our clients are looking in Toronto right now as well, just because the market has changed, as we said. However, what we are finding out is, yes, the price may not look that difference, but once you run all the expense, it's much more heavier in the end, and the cap rate is like right now on the market, what we see is the cap rate is still between, like, say, 3 to 5-ish. That's still the cap rate. So, like, for example, the reason why they use cap rate to evaluate multifamily is because how do you compare, a 6-unit building with a 20-unit building with a 100-unit building, right? It's really cap rate that people are looking at, which I'm sure, like, many people here are confused as to what is cap rate, which will explain our future series on multifamily. So when you compare those, the change we see is the cap rate in Toronto has been compressing over the years, but it's not being relaxed that much. But there are deals that we see. However, it doesn't fit the criteria we're looking at. For example, it's not purpose built; it's retrofit. For example, it looks like the price isn't that high, but when you factor in all the maintenance and repairs, etc., because in theory, even if you go to CMHC, the maintenance repair they budget is about 100 per door. However, in practice, because we own multifamily buildings, in practice, on some of these buildings, you could run up to 500 per door or even 800 per door. So after you factor all that in, you're going to be horrified at the cap rate and at the ROI. So what I'm trying to get at is there are pros and cons for choosing either duplex or triplex or multifamily. If you're looking at multifamily, the criteria will be different. And the numbers are not like the model that we have, and the numbers we look at multifamily is not like the sheet you're looking at now. It's a totally it's a totally different model, which we will actually get into details when we actually talk about share information about multifamily. Yeah. So honestly, I'm not sure if I answered any.
But you're not having to, like, build a new garden suite. You're not having the construction, but you are going to have maintenance costs as well. But that's part of the whole thing, right? Yeah. So they've done all the work for you. At some point, you're going to have to get it invest money in order to upgrade the units to a better standard.
That's right.
But you're already making revenue, right? So you're making a substantial amount of revenue. In the meantime, then you can do that in like 5 years, say.
Yeah. The problem with that is, that when you're talking about the lending really makes or breaks a multifamily deal. So they're not going to lend at 60%. They're not going to lend at 70%. They're going to lend, based on our experience, actually between like 35 to like 55%. So unfortunately, that's why, like, if you're looking at the same price, the bank will lend you a lot more money. You're gonna put a lot smaller down pay in like duplex, triplex, or not even triplex, like in duplex or a garden suite, whatever, than if it's like a multifamily. But it's a totally different model. It's already making revenues. It's its own category, which we're gonna have a very good discussion when the topic comes up, I guess.
Okay.
Yeah.
It just when I was looking at this, it's like, I know they're different, but it's like, I mean, from the price points, it's different in terms of like how much revenue you're going to get, and and you're talking maybe, I mean, I was talking with a friend of mine, and we're looking at buying like 1.3 triplex. I'd live in one unit, she'd live in
Yeah,
the other unit, and then
yeah,
we'd rent out the third unit, right?
yeah.
One
So
point three.
yeah, so this is where I was saying, like, in this market, I don't recommend you to build. I recommend you buy. Like,
Yeah,
buy something that's already built with a garden suite or buy a triplex. That's
yeah,
why we made the different scenarios here, and that's why I said, like,
yeah,
I will show you the numbers of construction, which you will make more,
yeah,
right? Like, you will make more. But for somebody new starting out, like, honestly, I recommend you to buy, not to build.
yeah, me too.
Yeah.
Because I agree, like, I mean, in terms of you're just doing fixing, you're just like, it's not cosmetic. Some of the stuff will be like wiring and stuff like that, but it's nothing like trying to come up with a new design to, to create and make sure that you have pull all the permits
Yeah.
and everything like that in terms of making a garden suite or
Yeah.
a basement apartment.
Right, but just hear me out. If you were ever to do that, please make sure whoever you work with, like, you make sure you still check the permit, you still check the
Oh,
zone.
I mean, this is just,
I'm
yeah, it's just here. Like, I mean, it's just an idea, right? So,
in Toronto, I can
I
tell you
would,
this, we monitor it, and 80% of them are not legal. It's only the 10 to 20% that are legal. So just
yeah, I know. But you're also you're creating something new as well, right? So you're making a safe apartment, right? So,
yeah, because if you want to hold it and want to sleep at night, like, don't
yeah,
have
yeah.
litigation,
Because I
like,
don't want to get sued, right?
exactly.
So,
And if anything happens, and if the zoning doesn't work out, or if the permit doesn't work out, like,
yeah.
you'll be sued your pants off. Like, what if a
I
fire,
know, I know, I know, I
right?
know.
That's why. Yeah.
And that's one of the reasons why, I mean, like, I don't know, in terms of going through all this process,
Yeah.
I mean, like like investing in a RIT, like, and still making a return and not
Yeah.
having to go through the headaches of
Yeah.
like tenants and construction.
Mm-hmm. Yeah.
It's a lot. I mean, yeah, the money's there, but it's just
Yeah.
it's a job. It's a
Yeah.
second job.
Yes, it is. It is. We made
Yeah.
it our full-time job. It's a job. All right.
All right.
Yeah, that's a good discussion. So let's hopefully we discuss more on the multifamily session.
Yeah.
All right. Okay. Let's look at Barry. Barry numbers will be slightly smaller. So but the same logic. So right now, you can actually purchase a legal duplex for about 800K. And your construction roughly about 300K. And your rental income, these are real, like 2,200, 1,700, 1,700, and we achieved higher. So we achieved actually 70,000. We just used a lower number for more conservative reasons. And we have your property tax, insurance, utility, whatever. You have your annual expense. So with the same assumption, your cash, the short-term cash you need upfront is about 650, and your cash flow would be about 200 for A lender and about $70 for B lender, and you're able to take out roughly about 200K once construction is complete and you have your rent your garden suite rented out, and your after repair value for the entire asset after you built the garden suite is now roughly about 1.15 million. Okay, so your long-term fund needed is about 450, which is smaller than what you would need in Toronto. And using the same assumption, you're exiting in about 5 years, about 1.5 mil. So your mortgage balance at that time is around 600K to 650, and your profit is about 360 or 330, so above 300. And your ROI with an A lender is roughly like 16% plus, and your B lender is about 15% plus. All right. So overall, it's still pretty high return in theory, and your long-term fund tied in there is less than $500,000, which is less than Toronto. And this is where I come in. Like, we build a garden suite, like it's fun, but we don't recommend doing that right now. The construction cost is just really crazy. So what we recommend actually is for you to buy something with an existing garden suite already built, or a triplex, right? So in Barry, it's actually like we actually own a few assets like this. We already have garden suite built in the rear yard, in the backyard. Okay, then you're looking at about 1.15 million purchase price. Your rental income upfront is about 67,000, and your annual expense about 50,000. So with all the same assumption, going to A lender or B lender, with the rate that's really high, like 5.5% or 6.5%, you're looking at tying about $500,000 in these assets, and your cash flow would be between like $70 to like $200 ish, and you would exit around 1.5 million, and your profit would be around 300K or $250,000, and your ROI is about 11% above or 10% above. This is, again, like your money tied in here is less in Toronto, and your ROI is a few points lower, but it's safer. It's already built. You already have the income. You just have to operate it.